Hello, and welcome to this webcast on the 2023 Japan tax reform. My name is Carl Grandel. I am a transfer pricing partner here at EY Japan, and I will be your moderator for today. This webcast is geared primarily toward inbound companies, in other words, foreign affiliated corporate taxpayers. That said, the information is also useful for anyone with an interest in the Japanese tax reform. If you prefer to view a webcast in Japanese, you can view our Japanese webcast on demand. That webcast was originally broadcast on January 25th, and you can find the link on your screen in the box titled Resource List. There's also a link to today's slides. With those points out of the way, let's turn to the 2023 tax reform. The tax reform this year reflects Japan's response to conflicting challenges. First, there is a need to boost the economy. Over the last 20 years, the annual average growth of the Japanese economy was only 0.6%, lower than most other large developed countries. In recent years, the Japanese government has attempted to address this with tax law changes designed to incentivize long-term investment and wage growth. In this year's tax reform, the government is trying to build on prior efforts to encourage R&D, innovation, and digital transformation, all of which are seen as necessary for long-term growth. We will cover these new and revised incentives in today's webcast. Another, more recent challenge for Japan is geopolitical. With increasing fears of confrontation with China and North Korea, Japan is raising its defense spending significantly. For the fiscal year beginning this April, it is estimated that the country will spend a record high of 6.8 trillion yen on national defense, compared to 5.4 trillion yen in the current fiscal year. In order to pay for all of this new spending, the government has announced increases in corporate taxes, individual income taxes, and tobacco tax. But the timing of those increases has not been specified, other than to say that those taxes will be raised at an appropriate time, sometime in or after 2024. The new taxes are supposedly for the purpose of funding the increase in defense spending, but there is a much larger long-term problem, and that is Japan's national debt. Although tax revenues are projected to hit a record high in 2023, tax revenue growth in Japan over the last 20 years has been much slower than in other developed economies, such as the United States, Germany, and the UK. As a result, Japan continues to run large fiscal deficits every year, and the national debt is now over 260% of gross domestic product. The tax increases announced this year will not be enough to get Japan's deficits under control, so we may see increased enforcement activity in the form of aggressive tax audits. Later in this webcast, we'll provide a brief tax controversy update. So as you can see, the Japanese government is struggling with the competing priorities of trying to stimulate economic growth while increasing tax revenues to cover defense spending and to make a dent in the fiscal deficit. It will be interesting to see how the budgetary and economic situation plays out in the coming years. So let's turn to our agenda. In addition to the items I've already mentioned, there are some significant updates to Japan's international taxation rules to reflect the implementation of certain aspects of BEPS 2.0. So we'll cover that as well. We'll also briefly discuss the main changes in terms of individual taxation. Overall, the extent of tax law changes this year is not quite as significant as we've seen in some previous years' tax reforms. So today's webcast will cover not only the tax reform, but also some other updates in regard to taxation in Japan. Those other updates will include reminders about a couple of significant upcoming changes, namely the introduction of qualified invoicing for Japan consumption tax and the new electronic retention rules. We'll also provide an immigration update, as Japan's entry and visa rules have been in flux for the past few years during the pandemic. And we'll finish with some updates on transfer pricing, mainly transfer pricing for financial transactions and also tax controversy trends. We have 75 minutes, including hopefully some time for Q&A at the end. Now I'd like to introduce our speakers, all of whom are based in Tokyo with EY Japan. And you can see me on the left there. I've already introduced myself. So we'll go to Balaj next to me on the screen. Balazs Naji is an associate partner in the business tax advisory team. He was working for the transaction tax group for more than 10 years before he joined his current team. He provides a wide scope of services to foreign clients doing business in Japan, including general corporate tax, corporate reorganization, withholding tax, and electronic retention. Mark Brandon is an associate partner. He practices in the areas of Japanese taxation and international corporate tax with a number of large foreign-based corporate and fund-related clients. Yoshito Kijima is a partner in our immigration practice. He has provided advisory for global mobility operations and immigration compliance services to both foreign and Japanese companies for nearly 15 years. James Gualtieri is a director in the transfer pricing team, providing advice to both foreign and Japan headquartered clients. Prior to moving to Tokyo, James started his career with the transfer pricing team of EY US in the New York office. One of James's core practice areas is the transfer pricing applied to financial transactions and other risk transfer arrangements. And now let's turn to our first topic, which is domestic law changes relevant to corporate taxpayers. As I mentioned at the top of the webcast, the Japanese government continues to try to boost economic growth through a number of incentives targeting R&D and other economically beneficial activities. But before we address those, we wanted to provide a quick reminder on two other major changes for corporate taxpayers: the introduction of qualified invoicing for consumption tax and changes to the electronic retention rules. Balazs will take us through those two areas, and then we'll explain this year's changes to the corporate tax incentives. Balazs, over to you.
Carl, first of all, thank you very much for the introduction, and let me talk about the first topic, which is Japanese consumption tax and the introduction of the qualified invoicing system. So the 2000 tax reform brings very, very important changes, but I must say we think that the most important tax event is the start of qualified invoice system on the 1st of October 2023. So what does it mean to us? So it's a simplified statement, but Japanese consumption tax will be invoice-based, so potentially it will be closer to European VAT systems. Now, the Japanese government introduced these rules a couple of years ago in order to give taxpayers time to prepare. Now, if you take a look at the 2023 tax reform, you see very, very small changes, but I think it is very important to recap on, I would say, the main rules. So first of all, if you're a consumption taxpayer, you can decide to register and to become a qualified invoice issuer, and you will get a registration number from the tax office. So what will happen to you is from now on, that if you issue an invoice to your customers, they can credit input consumption tax only if you issue a qualified invoice to them. And from a purchase side perspective, when you buy goods and services from your counterparties, you can credit input consumption tax only if you receive a qualified invoice from them. So let's first talk about how the invoice format will change. And I just show a couple of items here. First of all, the invoice has to show the consumption tax registration number. You have to show the applicable consumption tax rate, and you have to show the consumption tax amount per consumption tax rate. So let's go to the next page, please. And this page just basically gives you an example. So if you take a look at the invoice format on the left side, you can see a kind of an invoice which we use today. And then if you take a look at the invoice format on the right side, you can see what this new invoice will look like. So as you can see, we highlight that you have to show the tax registration number. And as I've just mentioned, you also have to show the exact consumption tax rate, and you have to show also the amount of consumption tax per consumption tax rate. You may have the impression that, well, the changes are not very, very big because you just change the format of the invoice and that's it. But the situation is a bit complex because there are quite a few other rules to consider at the same time when they introduce qualified invoicing. And I cannot give you all the details. I just give you a couple of items for consideration. So for example, what are the rules? How can you, for example, translate foreign currency amounts into Japanese yen for consumption tax purposes? How can you, for example, round up and round down consumption tax amounts? What kind of situations, what are those situations where you can credit input consumption tax even if you do not get a qualified invoice from your customer? And what happens, for example, if you buy goods from an enterprise which is tax exempt? Or what happens if you have transactions, for example, with commissioners? So I must say you have a long list of issues to consider. So changing the invoice format is not the only point to consider. So I think these examples just show that the Japanese consumption tax, this change can affect the sales side and the purchase side as well. And let's go to the next page. And this page just gives you basically a kind of an understanding of what kind of issues you have to consider as far as your sales side is concerned and what kind of issues are important here for your purchase side. I must say this list is of course not exhaustive. It depends on how complex your operations are and on many other factors. But let me highlight one important point here is systems requirements. So, and let me just go back to the first example. So you have to change the invoice format. You have to show your tax registration number on the invoice. And you have to, for example, show the consumption tax amount per consumption tax rate. Changing the invoice format is, I must say, it's easier said than done. So for example, if you are a Japanese subsidiary of a foreign multinational company, I expect that you use their global system. So potentially you have to talk to the global team. You have to explain how you want to change the invoice format and what kind of other changes you have to make only for Japan to be able to introduce this qualified invoicing. So it can affect your sales side and purchase side at the same time. And I must say we see situations, for example, when companies use one system for the sales side, they use a separate system for the purchase side. So basically you have to talk internally, for example, to two teams, and maybe you have to talk to several global teams at the same time. So the introduction of the qualified invoicing is not rocket science, but I expect that it takes time. So if you take a look at the overall time frame, so the qualified invoicing starts on the 1st of October 2022. So it seems, or you may have the impression that you still have a lot of time left, but as this example shows, you have quite a few things to consider. So my recommendation is that if you haven't taken any action yet, I think you should start looking into this issue because time is running out. We do not really have too much left, and potentially you should be ready to start qualified invoicing on the 1st of October 2023. So this is basically my main messages as far as consumption tax and qualified invoicing is concerned. So this is my first topic, and then let me go to the next page, please. And I will talk about a completely different subject, but this subject is also pretty important in the Japanese tax context. So electronic retention, e-retention. So basically I will speak about how to keep tax and accounting records for tax purposes. But before I talk about the 2000 tax reform changes, I think we just have to refresh our understanding about what the overall background is. So first of all, under Japanese tax law, you as a taxpayer, you are required to keep financial statement documents, invoices, and other documents for at least 7 years for tax purposes. And the default retention method is payable under Japanese tax law. And it is pretty important. This discussion is very, very important to keep proper tax and accounting records, because if the tax auditor comes along, you can end up in a penalty situation. So for example, the tax auditor tells you that, for example, you cannot really support a certain expense. There are no documents, so they want to disallow, for example, that expense for corporate tax purposes. They may say at the same time that you cannot credit input consumption tax in those expenses. The worst case scenario for you is that the tax auditor comes along and says, you do not keep proper tax and accounting records at all, or we will estimate your taxable income without looking at your tax and accounting records. So I must say it's a pretty important subject. It's a very important topic, just to confirm that you keep proper tax and accounting records for Japanese tax purposes. The Japanese government, of course, wants you to go paperless and to start e-retention. So they introduced these so-called e-retention rules a couple of years ago. Now, these rules, I would say, were very, very hard for taxpayers to meet. So what we see as a trend is that the Japanese government kind of relaxes these e-retention rules almost every year. So let me talk about the e-retention areas we have in Japan. So as you can see, ledgers, financial reports, and data documents and electronic transactions. And let's go to the next page, which I think gives you even a better illustration of what I'm talking about. As you can see, we have these 4 groups. I think if you download the slides after this presentation and you have time to take a look at this page, you will see exactly what kind of items are covered under these groups. But let me make a couple of comments about electronic transactions because they are kind of special. So electronic transactions are those transactions where paper document doesn't exist. So for example, if you receive an invoice from your customer, the invoice is in a PDF format attached to an email, basically there is no paper document. Or for example, if you download an invoice from your vendor, there is no paper document. So special rules will apply to these electronic transactions, but I will explain about these rules and the changes under the 2023 tax reform in a bit more detail. So let's go to the next page, please. And before I talk about these electronic transactions, I just want to clarify a couple of points about the overall background, because it's important that we all have the same understanding. So the good news about Japanese e-retention is that you are not obliged to use electronic retention. So basically you can pick and choose areas. So you can say that for whatever reason, I want to say paper-based, but I will use electronic retention, for example, only for employee expenses. It is perfectly possible. But electronic transactions are a bit different because the e-retention for these transactions is compulsory. What is also important to keep in mind that each e-retention area has specific technical and procedural conditions. So you have to meet these conditions. And if you take a look at this page, I just show a couple of conditions there, and let me highlight two conditions there. So if you take a look at the first condition, it is very important that your system has to have the ability to track changes and alterations to your tax records. Of course, the tax auditor wants to make sure that, for example, you cannot delete transactions from your accounting system. I also want to just make a comment about the search function related conditions. The tax auditor comes along, of course, your system has to have a certain search function so that the tax auditor can identify certain transactions. So let's go to the next page, and I will talk about electronic transactions. So again, just to recap, electronic transactions are those transactions where paper document doesn't exist. For example, an invoice in a PDF format attached to an email is basically an electronic transaction. So what happened in Japan before 2022 was that companies basically printed out these electronic invoices and created paper copies and kept those paper copies for Japanese tax purposes. And the Japanese government did not really like that because they said, well, we have electronic retention rules in Japan to help you to go paperless, but what you do is exactly the opposite. You create paper documents. So the Japanese government said from the 1st of January 2022, basically we want you to use e-retention for these electronic transactions. And what happened was that the Japanese companies were kind of complaining that we do not have the time to introduce the necessary systems, we will not be able to meet the deadline. So the Japanese government said, okay, we give you an additional 2 years to prepare. So in 2022 and 2023, even if you print out, even if you create paper copies, you can keep those paper copies for Japanese tax purposes. Again, Japanese companies were kind of complaining. They said that we still cannot meet the deadline. Therefore, the 2023 tax reform brings a new temporary measure. So under this new temporary measure, you are still allowed to create paper copies and keep those paper copies for Japanese tax purposes, but you have to keep the electronic data. And what is very important is that there should be a valid reason why you continue to create paper documents. So basically, the tax office doesn't want to give you a chance just to do nothing. You are expected to make an effort to start e-retention for these electronic transactions. So this point is very important to keep in mind. So let me go just to the last page of this section, and I would like to share some additional thoughts with you. It is also important that the 2023 tax reform simplifies some of the technical and procedural conditions, so it's easier for you to introduce e-retention. And what we would like to say is that we see, when we talk to our clients, we also identify specific patterns. For example, we see that foreign companies, especially Japanese subsidiaries of foreign companies, when they want to go paperless, they basically want to do specific or several electronic retention projects at the same time. So they say, we start e-retention for electronic transactions, but we also start, for example, scanner retention for employee expenses. We also see cases where for Japanese subsidiaries of foreign companies, they want to start e-retention together with the start of the qualified invoice system. So that's also a pattern which we see very often in Japan. But from a practical perspective, what I want to tell you is that if you haven't done any effort to introduce e-retention in Japan, I must say your primary focus should be on electronic transactions, because the application of e-retention is now compulsory. So this is my main message about e-retention. Okay, and then I'm going to go to my last topic, which is again something completely different, and I will talk about research and development related tax incentives. So let's go to the next page, please. So again, let me just give you some comments about the overall background. So R&D tax credits and tax incentives have been part of Japanese tax legislation, I must say, for decades. And what we see is that the Japanese government basically changes the rules almost every year to give you a chance to recognize more and more R&D tax credits. There are a couple of R&D tax credits. For example, I show on the page, you can see item 1. So you can take a tax credit for R&D activities, which you do yourself. Now, let me just make a couple of an important comment here is because there is a basic concept. If you want to take an R&D tax credit here, you have to incur net qualifying R&D expenses. So for example, if you spend 100 on R&D, but you recharge it to your head office, you don't have net qualifying R&D expenses, therefore an R&D tax credit is not available for you. Let me talk about another type of R&D tax credit, which is the open innovation R&D tax credit. So for example, if you outsource R&D activities to a third party, or you do joint R&D activities with a qualifying party, you can get a tax credit on those expenses. And there is an additional item, which is a bit different because it's not a tax credit, it's an additional deduction from your taxable income. If you make an investment into a qualifying company, you can deduct part of the acquisition cost from your corporate tax base. So let me just, let's go to the next page because I just want to make a couple of additional comments about the R&D tax credits. And first of all, let me talk about the base credit, the additional credit, and the new variable type credit. So these credits apply when you do the R&D activities yourself. And if you take a look at this diagram, I show the current situation and the future situation. You do not really see a lot of difference, but there are differences here. So first of all, what you have to keep in mind is that you can use these R&D tax credits up to a certain percentage of your taxable, of your corporate tax liability. So for example, if in a financial year you have a loss and you recognize an R&D tax credit, say $3 million US, you cannot really use them. Now, how does the 2023 tax reform changes the rules? Now, what is important to keep in mind is that, for example, if you spend 100 on R&D, it doesn't mean that you get 100 R&D tax credits. So this base credit, additional credit, new variable type credit, they all have very complicated formulas, how to calculate the final R&D tax credit. And these formulas take into account, for example, your current R&D spending, past R&D spending, and the sales, and other factors as well. I'm not going to go into the details because we do not really have too much time. But what I just want to say is, if, for example, you increase your incremental R&D spending by 100 under the current rules, and you increase your incremental R&D spending by 100 under the new rules, I expect that you will get a higher tax credit under the new rules. So basically, you have an incentive to spend more on R&D activities. Let me talk about the item which is down there, the open innovation item. So again, if you do R&D activities together with a qualifying counterparty, for example, with a university or a research institution, you can get an open innovation tax credit. I think it will be somewhere between 20 and 30% of the expenses, and you can offset that R&D tax credit against your corporate tax payable. Now, the 2023 tax reform brings in some new rules, and there is an interesting change. If you, for example, hire a PhD or somebody with high qualification, and you meet a long list of conditions, you can take a tax credit 20% of the personal expenses of the person. You can use that tax credit as an open innovation tax credit against your corporate tax payable. So I have covered the first two R&D tax credit items, and let's go to the next page. Here I want to talk about the third item. This is the so-called open innovation investment tax deduction. So just to keep it simple, if you make an investment into a qualifying startup company, and again, you have to meet a long list of conditions, you can basically deduct 25% of the acquisition cost of those shares for corporate tax purposes. There are, again, various conditions to meet. So for example, you have to become a more than 50% shareholder. There are rules as far as the investment amounts are concerned, and the holding period has to be at least 5 years for this investment. So just to summarize all these comments, so what would be the important factors for you from an R&D incentive perspective? So first of all, if in your operations, and we see it sometimes in practice, for example, if you do certain activities in Japan, for example, to adjust the functionality of a product only to meet the Japanese market requirements, sometimes you can identify R&D activities there, and you can basically pick up R&D tax credits. Now, what is also important for you is that the 2023 tax reform has revised the scope of qualifying R&D expenses. Maybe there is an opportunity for you there to recognize more R&D tax credits. And what we also find very important is that because the rules are a bit complex, I must say, that your compliance function fully understands the new rules and is fully able to apply these new rules when they take a tax return position on R&D tax credits. So that was my presentation, and back to you, Carl.
Thank you, Balazs. So even though this year's tax reform didn't contain a great number of changes, when you look at those changes together with the qualified invoicing and e-retention rules, we do see a lot of change coming up in 2023. So it was good to get that update from you. Before we turn to the next topic, just one more word about corporate taxation and domestic corporate tax in particular. I mentioned in the introduction that certain taxes will be increased to cover defense spending. One of those is the corporation tax, and the increase will take the form of a surtax of 4 to 4.5% on the corporate tax liability after deducting 5 million yen. The purpose of the 5 million yen deduction is to reduce the burden on smaller companies. So we're going to switch gears for the next 10 minutes or so. Up to this point, we've spoken a lot about Japan's domestic priorities and how those are reflected in the tax law. But we're going to look now at the international tax landscape. Most of you presumably have heard of BEPS, the OECD's projects to address base erosion and profit shifting. The latest round of BEPS proposals from the OECD, known as BEPS 2.0, is planned to be implemented globally within the next year or two, assuming most countries adopt those proposals. Japan has consistently expressed support for the OECD's BEPS proposals, and this year's tax reform includes the introduction of a number of rules suggested by the OECD. Mark will take us through those. Mark, over to you.
Thanks, Carl. As just mentioned, the OECD and G20 developments relating to BEPS 2.0 are the next stage in the global discussion on tax avoidance. So looking at this next slide, the majority of the work related to BEPS 2.0 is likely to be performed at the headquarters level, by a combination of the tax and finance teams. However, subsidiaries in local countries may be required to assist with such issues as reporting on financial information and effective tax rates, as well as keeping the headquarters team updated with changes to tax legislation and other tax and finance support. This should ensure that the BEPS obligations are met, and more broadly, that the group's tax governance and tax policy objectives are satisfied. Reporting for December 2022 year-end will give groups an opportunity to see how well prepared they are to meet the expected future requirements for BEPS 2 reporting, and where they may need further support, which, for example, could mean more personnel or the increased use of technology-type platforms. As we know from the first wave of the BEPS reforms, the rules can often be complex, so we'll provide a very brief overview of them here, and then also comment on how they could require the involvement of local subsidiaries in Japan or regional headquarters coordinating Japanese operations. Under BEPS 2.0, there are two key parts or pillars. Pillar 1 rules change how profits and taxing rights are allocated, using a formula-based approach to recognize a portion of the profits in market jurisdictions, as opposed to, for example, mainly where the IP is located. Pillar 2 is intended to discourage profit shifting to low tax locations for international groups. It does this by introducing a form of global minimum tax levied at the rate of 15%. This is also referred to as the anti-global base erosion or GLOBE rules. The Pillar 2 model rules are designed to ensure large multinational groups pay a minimum level of tax on the income arising in each jurisdiction where they operate. They are drafted as model rules that provide a template that jurisdictions can translate into domestic law. We should assist them with implementing the rules within the agreed timeframe and in a coordinated manner. Japan has now decided to move forward with the implementation of Pillar 2, so it will broadly adopt the following principles. Taxpayers that either have no foreign presence or that have less than Euro 75 million in consolidated revenues are not in the scope of the model rules. In addition, the rules do not apply to government entities and international organizations, nor do they apply to entities that meet the definition of a pension, investment, or real estate fund. Taxpayers in scope of the rules calculate their effective tax rate for each jurisdiction where they operate and pay top-up tax on the difference between their effective tax rate per jurisdiction and the 15% minimum rate. Any resulting top-up tax is generally charged in the jurisdiction of the ultimate parent of the group. A de minimis exclusion applies where there is a relatively small amount of revenue and income in that jurisdiction. In order to know if top-up tax is owed, rules are needed to calculate the effective tax rate, or ETR, in each jurisdiction where the group operates. This requires first a calculation of the income, and second, a calculation of the tax on that income. The income or loss is calculated based on financial statements. Certain adjustments are then needed to better align the financial statements and tax, including where there are timing differences in recognition of income or expenses. The tax attributable to that income includes normal income taxes. The rules also allocate income taxes which are charged as a withholding tax or a tax due under a controlled foreign company regime, which is a type of tax avoidance system. However, non-income-based taxes such as indirect taxes, payroll, and property taxes are not treated as income taxes for these purposes. Due to the impact of the BEPS changes, the 2023 tax reforms also propose amendments to Japan's CFC rules. Once the effective tax rate is calculated, it is then determined how much top-up tax is owed, which is the difference between the 15% and the ETR in the jurisdiction. That top-up tax is then applied after deducting a substance-based income exclusion, which is related to tangible assets and payroll costs. The primary rule applicable here is the Income Inclusion Rule, or IIR, which to some extent is based on controlled foreign company rules and also resembles the US Global Intangible Low Tax Income regime, which is sometimes referred to as GILTI regime. Briefly, it effectively triggers additional taxation, i.e. the top-up tax, at the level of the parent entity where the group's jurisdictional ETR is below the agreed minimum tax rate. Japan's 2023 tax reforms will include legislation for the introduction of this income inclusion rule. As part of the legislation, measures will be introduced to reduce the administrative burden on those companies in scope of this new rule. Japan will take into consideration the latest discussions on this topic with the international community, and then in light of the need to monitor developments in other countries implementing these rules, as well as to give companies ample time to prepare for the new admin procedures, this rule in Japan will apply to fiscal years beginning on the 1st of April 2024 or after. Moving on to the next slide, where it is not possible to bring low tax income into charge under the IIR, a second rule should be applied. This is called the Undertaxed Profits Rule, or UTPR. This rule works by requiring an adjustment that increases the tax at the level of the subsidiary. The adjustment is an amount sufficient to result in the group entities paying their share of the top-up tax remaining after the IIR. The share of the top-up tax is calculated based on a formula in proportion to the relative share of assets and employees in the jurisdictions. A number of items are expected to be further discussed in detail by the OECD this year, such as the UTPR, or Undertaxed Profits Rule, and also the Qualified Domestic Minimum Top-Up Tax, or QDMTT, as is known. At the earliest, these two rules may be included in next year's Japanese tax reforms. Opinions and feedback from the international community on these topics will again play a major role in any future discussions and proposals in Japan. So that was a quick, high-level view of the BEPS 2 proposals and their status in Japan. Before moving on to the next topic, we will mention some of the considerations for finance and tax staff in Japan. One issue, indeed probably a necessity, will be that tax and finance teams across the worldwide globe, including Japan, should work together closely to satisfy these requirements and help ensure consistency among tax and accounting data. As stated at the start of this section, the year-end processes currently underway for many international groups offer a great chance to measure the organization's readiness to comply with the new data and reporting requirements that the BEPS 2 rules will impose for 2024 onwards. During the current year process, you can begin the BEPS preparations by identifying what data you already collect, how much of this data needs to be adjusted before it can be used, and what other information might be needed for compliance or to support exclusions or adjustments, e.g. tangible assets, payroll, and other such data. Moving on now to the next slide. This slide shows a typical TMK, TKGK structure. TMK and TKGK, combined or separately, are structures that are commonly used for investments into Japanese real estate by foreign investors. A TMK is a type of special purpose company, while a TK is typically translated as silent partnership, but is more accurately a type of contractual arrangement, while a GK is a type of Japanese company that is very similar to a US LLC. This structure provides certain tax benefits where dividends or distributions are deductible for corporation tax purposes. This typically results in a corporation tax rate of over 30%, becoming a lower tax rate of approximately 21% for a TK-GK alone, and approximately 13% or 14% for a TMK plus TK-GK. However, the arrangements incur higher setup costs and ongoing maintenance expenses. We understand that the investment fund and pension fund industries are not the targets of the BEPS reforms, and there are a number of relevant exemptions to such structures. Based on our current reading of the general BEPS proposals and how they are expected to be introduced into Japanese legislation, we note that a TK's income and related Japanese withholding tax is expected to be included in the TK investor entity's income and tax for these purposes. So the rate there should probably be above 15%, and so should not be subject to a top-up tax. A GK entity and a TMK entity both have tax-deductible distributions, so could potentially be viewed as subject to tax rates lower than 15%. However, it will be important to see how Japan further develops, interprets, and applies the BEPS 2.0 rules, especially in relation to qualified domestic minimum top-up tax. Moving on to the final slide here for this section. Under the previous BEPS initiative, various changes to bilateral tax treaties could be made using an instrument that includes certain tax-related principles mutually agreed between the two parties. Under these processes, two such agreements are now being implemented. One is the Japan-China Treaty, and the other is the Japan-Hong Kong Treaty update. These will be amended to include the OECD recommended principal purpose test, which can result in the denial of tax benefits where obtaining the tax benefit is seen as the main purpose of the transaction or arrangements. The China Treaty is amended from 2023, and the Hong Kong-Japan Treaty should be revised from 2024 generally. Moving on to one final point, which is the amended Swiss-Japan Tax Treaty. This is now effective from 1 Jan 2023, and the key changes are that the business profits attributable to a permanent establishment or branch will now be calculated by comprehensively recognizing the internal dealings, including payments such as interest, between the head office and branch, considering the functions performed there, the assets used, and the risks assumed by the enterprise through the permanent establishment. Furthermore, the principal purpose test will be aligned with the standard in the recent OECD version. In relation to withholding tax, the treaty provides for a full exemption in relation to dividends, where the beneficial owner of the dividend income holds at least a 10% interest for 365 days. The treaty now provides for a full exemption on interest, and furthermore, royalty income will continue to be exempted from withholding tax. So that was our brief update on international tax issues, especially the BEPS reforms and how they will be applied in Japan. So I'll now hand back to Carl to take us through the rest of the presentation.
Thank you, Mark. As I've said before, Japan has always expressed support for BEPS, and now we see them taking concrete steps to follow some of the OECD recommendations. We'll presumably see more tax law changes over the next couple of years as the rest of the OECD's proposals for BEPS 2.0 are finalized and become ready for implementation. We're going to change topics again, this time covering an area of interest both for expatriates working in Japan or planning to work in Japan and for the companies that hire them. The last couple of years have been a crazy time in terms of Japanese immigration policy as the rules changed drastically during the pandemic, but Japan has opened up recently. Yoshito will take us through the immigration situation now. Yoshito, over to you.
Thank you, Carl. So firstly, please go to the next slide. So firstly, I want to introduce shortly about the current border situation. As mentioned briefly by Carl, the border was closed for new entrants for around 2 years, and more than 400,000 foreign nationals waited for the opening. Currently, the border is opened with some quarantine requirements. No requirements if you have vaccine certificate, and if not, a pre-departure test is required. Since last December, travelers via direct flight from China and Macau need prepared pre-departure test and test on arrival. Also, travelers with travel history to China will also need pre-departure test and test on arrival. Now, Japanese government announced that the classification of COVID-19 will be downgraded on May 8, 2023. Due to this action, it is expected that all quarantine requirements will not be required anymore, including the temporary measures against travelers from China and Macau, or entrants with travel history to China. By this, Japanese border will go back to pre-COVID time. Next slide, please. I would like to walk through Japanese immigration landscape. I want to introduce how Japanese immigration policy has been made and some topics from tax perspectives. Japan is now facing with falling birth rate and aging population, which is estimated to decrease around 10% by 2040, which means there will be decrease around 7 million labor force by 2040. To fill this decrease, one of the key policies is to promote Japan to the foreign workforce. For instance, Financial Service Agency promotes foreign investors by several incentives. Government introduced new visa status called specified skilled labor, who are going to deal with rather a routine work in particular industries where a lack of labor force is critical. Next slide, please. The number of foreign workforce has been increasing year by year. According to the latest data issued January 27, the total number of foreign workforce is 1.8 million by end of October 2022. It is 5.5% increase comparing to previous year. Considering the fact that Japan border was closed until 2022 March, this increase indicates strong growth of foreign workforce in Japan, and the number may go over 2 million in 2024. Though, considering the fact over 7 million labor force will be decreased by 2040, the increase is not large enough to fill this gap. Having said that, Japan is trying to introduce some other policies to attract highly skilled professionals, as well as routine workers into Japan. When we see the breakdown of nationalities of workforce, the largest is Vietnam, which is approximately 25% of the foreign nationals in Japan. This is actually a new trend in the last few years, where China was the largest population in Japan for long in the past. Next slide, please. Now, I would like to introduce current trends of Japanese immigration. Firstly, Japanese government are promoting highly skilled professionals to work in Japan. If they obtain visa status called highly skilled professional, they can apply for permanent residency minimum in 1 year residency, allow sponsoring housekeeper, and bring parents to Japan with long-term visa if such foreign national has child or pregnant in Japan. This criteria is expected to be relaxed soon, especially workers with high income salary. Also, Japanese government is expected to introduce new visa category for graduates of top 100 universities to stay in Japan for 2 years to seek employment in Japan or to work in Japan as an intern. Secondly, Japan immigration has introduced online application recently. As of now, most of the immigration applications can be filed online. However, as it is rather new portal, the processing time is unstable, so still majority of the applications are filed in person. The online platform is expect the reformation by digital agency, and smoother processing is expected under this new portal. Thirdly, to fill the industries where the lack of workforce is critical, such as hotel, restaurants, nursing home, there is a new visa status introduced. This is called specified skilled workers, and the number is increasing. Also, there's a visa status called technical intern training, which also allows workers to obtain skills during the stay to bring it back to their home country. Currently, government is in discussion to reform these two visa status to meet the high needs from the industry. Fourthly, promoting investors is one of the focus. Financial Service Agency launched project to attract foreign investors. Under this project, the process to apply for the business license to operate financial business can be completed in English. Also, foreign national works in financial industry can have benefit to sponsor 2 housekeepers and relaxed criteria to apply visa status called highly skilled professional under some conditions. Another trend we see is the interest from high net worth who seek residency into Japan. There's no program to obtain citizenship residency by investment where other countries have. Though by combining some immigration processes, there is a possibility to obtain permanent residency, and it is getting more attention from high net worth from various countries. Next slide, please. Lastly, I wanted to share information exchange with relevant authorities. Immigration set up intelligence center a few years ago and collecting information around foreign national to monitor their stay in Japan. As mentioned, Japan is opening its door to foreign workforce and trying to lower the hurdle to enter Japan. On the other hand, the monitoring and screening after the entrance will be tightened. Especially the NTA and immigration has been exchanging information in specific area. For instance, in 2019, NTA and immigration agreed to share individual tax status of foreign national with visa status specified skilled worker and corporate tax status of its employer in case the status is maliciously violated. In 2020, NTA and immigration agreed that NTA will share corporate tax status of foreign national with status business manager to the immigration in case it is maliciously violated, and immigration to share the immigration status with NTA. In addition, it is expected that my number will be shared with immigration. Digital agency announced they will develop portal for immigration process which will collect the my number. By sharing the my number, key information such as the amount of salary, bank account, social security will be shared with immigration. Having said that, tax compliance, including social security compliance, become more critical for immigration perspective. In case of failing such compliance, it can lead to denial of visa application. I have seen a case that spouse's visa was denied because of the negligence of tax compliance of her husband's individual tax payment. And this information exchange is expected to be accelerated with broader type of information and authorities. We will share these trends timely so that clients can achieve smoother expatriate to Japan and smoother migration to Japan. Back to you, Carl.
Thank you, Yoshito. Before we switch back to corporate matters, I just wanted to spend a few minutes on individual taxation. Can we move a couple of slides forward? And one more. There we go. As some of you know, we held a webcast on November 10th in relation to inheritance tax in Japan. And we mentioned that there may be changes to the inheritance tax in the upcoming tax reform. Well, the changes that were announced are in regard to the relationship between inheritance tax and gift tax. As we explained in our previous webcast, it is possible to elect to settle gift taxation upon inheritance. What this year's tax reform does is to provide a basic deduction of 1.1 million yen on that gifted amount, which is the same as the basic exemption for gift tax. Also, under the current system, the value of assets gifted within 3 years prior to the inheritance should be added back to the estate and subject to inheritance tax. But this year's tax reform extends that add-back period to 7 years. If the bill passes as proposed, the revisions will be effective from January 1st, 2024. Another change to individual taxation is a new minimum tax on those with very high incomes. Put very simply, this minimum tax is calculated by taking the amount of income that exceeds 330 million yen and multiplying it by 22.5%. If that amount exceeds the amount of standard national income tax for the year, then additional taxes will be levied equal to that excess amount. And finally, as part of the effort to fund higher defense spending, the government has announced a new surtax of 1% on individual income tax. At the same time, however, there will be a reduction in the existing special reconstruction tax for the 2011 East Japan earthquake from 2.1% to 1.1%. So as you can see, the overall tax burden on individuals stays the same, but some of the tax revenue is redirected from reconstruction to defense. But to ensure that there will still be enough money for reconstruction, the time period for the reconstruction tax will be extended beyond the original end date of December 2037 for an undefined period. Presumably, the extension will last until the reconstruction costs are covered. And as I said in the introduction, the timing of this change is not yet certain. The ruling coalition has only said that it will happen sometime in or after 2024. So that's it for our individual taxation update. Now let's go back to corporate taxation. In the past year, the transfer pricing rules have been revised in relation to intercompany financial transactions. James is going to take us through those changes. James, over to you.
So thank you, Carl. If we could move to the next slide. So recently, there have been updates to the NTA's administrative guidelines around financial transactions transfer pricing. And the administrative guidelines serve as a reference from the NTA around how to interpret Japan's transfer pricing rules. As a bit of background, under Actions 8 to 10 of the BEPS 1.0 initiative, the OECD worked to develop guidance around financial transactions, which previously didn't exist. In February 2020, the OECD released their final guidance, which was subsequently incorporated into the OECD guidelines as Chapter 10 in January 2022. And following the formal update of the OECD guidelines, in March 2022, the NTA released proposed edits to the administrative guidelines for public comment, which were generally consistent with those updates. In June, these edits were finalized, and they have effect to financial years beginning on or after 1 July 2022. So the updates deal with 3 categories of financial transactions: loans, financial guarantees, and cash pooling arrangements, and I'll discuss them in that order. So if we could move to the next slide. So starting with loans, prior to the administrative guidelines update, the previous guidance provided a hierarchy of methods that could be applied to determine the interest rate in a related party loan. So first, if evidence of interest rates that a third party would charge to the borrower were available, then those interest rates should be used. If those didn't exist, and there was evidence of interest rates that a third party would charge to the lender, then those should be used. And lastly, if neither existed, rates on comparable government debt could be used. So effectively, this meant that if a taxpayer could establish that there was no evidence of the interest rate that would be applied by a third party to the borrower, group external borrowing rates or even government rates could be used as a quasi-safe harbor. So in addition, there was limited guidance around the specific factors which should be taken into account when determining comparability for a loan. It wasn't uncommon to see rates based on the group's external average borrowing cost or non-binding quotes from a local bank with whom the taxpayer had a relationship. The updated guidance eliminates the hierarchical approach and provides more clarity around how to determine interest rates in related party loans. So the first step in the analysis should start with an evaluation of the economically relevant characteristics of the loan. And what this means is that the taxpayer should understand the underlying facts of the transaction that have an impact on its price. So these include general contractual terms such as currency, timing, tenor, and subordination, but also include economic and background factors such as the borrower's creditworthiness, geographic location, and industry, as well as the purpose of the loan. So in a nutshell, a taxpayer should be considering all the elements of the transaction, which would have a material effect on its pricing in the market. So there's also a question of whether the terms and conditions applied in a loan actually match up with the behavior of the parties. For example, it could be the case that a loan is contractually entered into for a period of 1 year, but that loan is used to fund the construction of a facility that will take 5 years to complete. And in this case, it can be inferred from the behavior that the loan should have had a tenor greater than 1 year. Identifying these types of inconsistencies are one of the reasons the economically relevant characteristics should be examined. So similar to the guidance around the financing of intangible asset development, it's also noted that the lender should have sufficient functionality in order to manage the risks that it's undertaking. So in cases where that functionality doesn't exist, it's noted that the lender's return should be no more than the return in a comparable risk-free asset. So no threshold of activity exists for making this determination, and it's reasonable to assume that a lender in a related party loan wouldn't be expected to have a rigorous risk management framework at the level of a commercial bank. But the key takeaway here is that there should be some evidence of decision-making control and management. One of the other key elements in determining pricing in a loan is the creditworthiness of the borrower. And this can typically be determined by the estimation of a credit rating for comparison with external benchmarks, and there exists a variety of quantitative and qualitative tools to do so. So a key point in the update around credit ratings has to do with what's called implicit support. And implicit support refers to the fact that certain group entities may play a pivotal role in the group's business or be very integral to their overall strategy. And as a result, purely as a function of their role in the group, their credit rating should achieve some sort of uplift to the level of the overall group. So the updates note that this should be taken into account when estimating the credit rating of a group entity. So taking into account the points previously mentioned, the interest rate on a related party loan should be benchmarked based on comparable data on third-party lending arrangements that are aligned on the relevant factors. And this means that historical approaches using the group's average cost of funds or the lender's cost of borrowing are generally no longer acceptable. Furthermore, only data from actual transactions represent reliable benchmarks, and therefore benchmarks based on estimated interest rates or non-binding quotes from third-party banks are generally no longer acceptable as well. The OECD guidelines also contain input around whether a loan is accurately delineated as such for tax purposes, or whether it would more accurately be considered equity. For example, it may be the case that based on all reasonable expectations, the borrower would be unable to service or repay its debt over its tenor. Or when comparing the borrower's leverage with the data on public lending transactions, it's clear that an independent lender wouldn't provide debt funding at a similar level. In these cases, the OECD notes that a loan provided under these circumstances may be more accurately considered to be an equity investment. And the primary purpose of this guidance is to ensure that companies don't deduct interest expense based on a level of debt that is unsustainable and inconsistent with the market. So the administrative guidelines updates don't contain any reference to this section of the OECD guidelines. And on this point, it's worth noting that Japan has prescriptive rules around thin capitalization and earnings stripping. Specifically, the thin capitalizations rules have a safe harbor debt to equity ratio of 3:1. And under the earnings stripping rule, net interest expense from all debt, with some exceptions, is limited to 20% of adjusted taxable income. As a result, it may be the case that the NTA considers the limitations imposed by these rules to be sufficient for preventing excessive interest expense deductions from related party transactions. So if we can move on to the next slide. So moving on to financial guarantees, a financial guarantee is generally provided to uplift the creditworthiness of the guaranteed entity and reduce the risk to the third-party lender or obligor. This is generally expected to provide a benefit to the guaranteed entity in terms of reduced interest or other payments. So unlike the case of loans, no previous guidance existed around the pricing of financial guarantees. So 3 specific approaches are listed in the updates to the administrative guidelines. However, it's noted that these are not the only methods that can be applied, and taxpayers may consider other reasonable methods, such as the additional approaches listed in the OECD guidelines. So the first of these approaches is the yield approach. And the yield approach determines pricing for a guarantee of a loan by reference to the interest rates that would have been applied to the borrower both with and without the presence of the guarantee. The difference between these rates is referred to as the yield spread. And for example, if a borrower was estimated to have a credit rating of BBB without the guarantee and a credit rating of A with the guarantee, the yield spread would be equal to the difference between BBB and A borrowing rates. The yield spread typically represents the maximum benefit of the guarantee to the guaranteed entity. In other words, if the guaranteed entity only received a reduced interest rate as a result of the guarantee and paid the entire yield spread as a guarantee fee, then it would be the same as if they had borrowed without the guarantee in the first place. Therefore, once the yield spread is determined, only a fraction of it is typically paid in order for both the guarantor and the guaranteed entity to benefit from the transaction. In practice, something in the range of 50 to 70% is typically applied. When applying the yield approach, the guidance around benchmarking intercompany loans discussed previously should similarly be taken into account. So the second approach is the cost approach, and the cost approach determines pricing for a guarantee by estimating the expected loss to the guarantor as a result of providing it. Expected loss can be calculated by estimating the probability that the guaranteed entity will default, and therefore that the guarantor will have to make payment, discounted for any recovery the guarantor might expect to recoup from that entity. Lastly, there's the credit default swap approach, or CDS approach. And the CDS approach determines pricing for a guarantee based on the spreads applied in comparable CDS transactions. A CDS is a derivative transaction in which one party agrees to protect another party against credit losses on a debt security for a certain period of time. As compensation, a CDS spread is paid to the party providing the protection. So the credit rating of the guaranteed entity and the guarantor are really critical inputs in determining a guarantee fee. For example, if the guaranteed entity has a very weak credit rating and the guarantor has a very strong credit rating, the benefit of the guarantee may be quite large. Conversely, if both are pretty similar, then the benefit of the guarantee may be very limited. Similar to the case of loans, the guidance around implicit support in relation to estimating a credit rating also applies in the case of guarantees. In the case of a guarantee of a loan, there's also a question of whether the amount of debt guaranteed could actually have been borrowed by the guaranteed entity without the guarantee. In other words, would the lender have provided that amount of funding at any price without the guarantee? If not, then it may be the case that the amount of funding in excess of what the lender would have provided without the guarantee is more accurately delineated as a loan to the guarantor and subsequent equity contribution to the borrower. There's no clear guidance on this point in the administrative guidelines updates, and it's worth noting that Japan's thin capitalization rules also apply to related party guarantees. Therefore, it may similarly be the case that the safe harbor provided under those rules is considered sufficient to prevent excessive deductions through guarantee fees. Lastly, a guarantee should be evaluated to determine if it provides actual economic and commercial value to the guaranteed entity. Most commonly, this would be through credit enhancement, but could also be through other channels, such as the elimination of collateral, margin, or other requirements. However, in cases where it's determined the guarantee does not provide commercial value, no guarantee fee should be applied. And if we can move to the next slide. So lastly, I'll come to cash pooling. And there's limited guidance in the administrative guidelines updates around cash pooling, other than noting that the cash pool benefits should be reasonably distributed among the members. So to frame this guidance, I'll draw from the OECD guidelines more generally. So cash pooling is unique in the sense that these arrangements generally don't exist outside of a related party context. And in a cash pooling arrangement, rather than having each group entity deposit with or borrow from a local bank according to their day-to-day debit or credit positions, instead these entities will pool their funds together in order to set off debit and credit positions internally to the extent possible. So this allows for reductions in external interest expense. For example, suppose entity A has 10 million in excess funds and entity B has 10 million in funding needs, then these entities can benefit from a cash pool since entity A's excess funds can be used to fund entity B's funding needs, eliminating the cost of spread between deposit and borrowing rates charged by banks. So in a cash pool, typically one entity will be delegated as the leader and will maintain the relationship with the bank. The other entities, referred to as the participants, will pool their balances together within a single account in the name of the leader. The net amount will then be deposited or funded with the bank. So effectively in a cash pool, the leader is acting as a sort of in-house bank through which the participants who are depositors fund the participants who are borrowers. However, the particular role of the leader varies. And at one end of the spectrum, there may be a cash pool where the leader performs only an administrative function. And on the other hand, the leader may be acting as a full-fledged in-house bank, performing the necessary cash management and risk management functions. In many cases, the role of the leader tends to be somewhere in between. So as I mentioned in the example earlier, the cash pool benefit reflects the savings achieved by all members as a result of entering into the cash pool. How that benefit is distributed should be informed by the role of the leader and the participants, and ideally can be determined through appropriately chosen borrowing rates. When determining those deposit and borrowing rates, similar guidance to that provided for related party loans should be applied as well. So the role of the leader will also determine whether and to what extent the remainder of any spread after remunerating administrative functions should be retained by the leader or redistributed amongst the participants. In cases where the leader only performs an administrative function, they should only be remunerated for those specific activities, and any excess benefit should be redistributed. Conversely, in the case where the leader performs a full-fledged financing management function, it may be appropriate for the leader to retain the entire amount. So it's also worth noting that a cash pool is generally put in place to cover short-term cash management needs for the members, and the deposit and borrowing rates reflect short-term rates. However, it's not uncommon for structural imbalances to materialize over time. For example, it may be the case that one or more entities end up depositing into a cash pool for very long periods of time. So it's advisable in these cases that the taxpayers monitor outstanding balances, and if this fact pattern arises, it should be replaced by long-term funding to the relevant entities. So in addition to the transactions I've just described, the OECD guidelines also included advice around related party hedging transactions and captive insurance arrangements. No updates were made to the administrative guidelines around these transactions, and given that they're relatively less common, I won't cover them here. So as a final concluding note, as with any new guidance, it's reasonable to think that taxpayers may receive increased questions around financial transactions during tax audits going forward. Therefore, it's recommended for taxpayers to review their existing arrangements and determine whether there are any gaps with the updated guidance. And with that, I'll turn it back to Carl to give an update on the Japan tax controversy landscape. Back to you, Carl.
Thank you, James. And sticking with corporate taxation for just another few minutes, as James just said, I want to give our audience an update on the tax controversy environment in Japan. If we can go to the next slide, thank you. Now you can see some of the audit trends on the current slide. And let me just mention that the years shown here are based on the administrative year of the Japanese tax authority. So 2020 means the year ending June 30th, 2021. And these numbers come from the National Tax Agency's 2022 annual report. Now you can see that in the most recent 2 years, shown on this slide, the number of tax audits has declined by about 70%, mainly due to the pandemic, which caused tax examiners to refrain from visiting taxpayers. However, the total amount of tax adjustments only declined by about 30% to 40%. Now, we were to look at transfer pricing cases, which are not shown on this breakdown. The total of adjusted amounts in administrative year 2020 was actually higher than in 2018, even though the number of transfer pricing assessments fell by half. And in the time since the period shown on this slide, we at EY see that overall tax audits are increasing as we come out of the pandemic, although they are still not quite at the level. We don't see quite the number of tax audits that we saw right before the pandemic. At any rate, the question is, why have tax assessments not fallen by the same amount as the number of tax audits? And there may be a couple of reasons for that. One being that the tax authority is prioritizing larger taxpayers with the potential for larger adjustments. Another reason may be the new risk-based approach recently adopted by the Japanese tax authority. So under this risk-based approach, the selection of audit targets is now based on factors such as the state of a taxpayer's corporate governance, the taxpayer's business, financial data, previous transgressions, and progress in resolving past transgressions or problems. The intent is to target taxpayers with higher risk and to allocate the tax authority's resources more efficiently. It's also now the case that the tax authority has access to much more data than they did before. So for large multinationals, they have the country-by-country reports, the transfer pricing master file, as well as a lot of information online that was not previously available. So the tax authority is looking at that information as well in deciding which companies to audit. One other item to note is that in recent audits, we are seeing the impact of a reorganization at the tax authority that took place in July 2020. Before this reorganization, transfer pricing audits were carried out by a specialized TP team within the tax authority and were generally conducted separately from the regular corporate tax audits. So a company might get a corporate tax audit every 3 to 5 years, but would only get audited for transfer pricing maybe once in 10 years or maybe even never, depending on the company. After this reorganization at the tax authority, there's now one team that covers all international tax issues, including transfer pricing and permanent establishment. And the new audit approach of the tax authority is for examiners to audit all corporate tax issues in one audit, meaning international and domestic issues. So many taxpayers are now being visited by both international examiners and domestic examiners in the same audit. And the audits now often include requests for transfer pricing documentation. This makes it more important to be up to date on TP documentation and to manage year-to-year transfer pricing and financial results to comply with the TP rules. Now, many of you know that one tool for managing TP controversy risk is the APA system. APA stands for Advanced Pricing Agreement or Arrangement. In many countries, Japan among them, offer taxpayers a means of negotiating in advance to get agreement from the tax authority to the taxpayer's transfer pricing. In Japan, the number of bilateral APA requests reached a new record high in the administrative year ending June 2022, with 188 new APAs requested by taxpayers. So as you can see, the program remains very popular among taxpayers and is widely regarded as an effective way to manage transfer pricing controversy risk. That's all for the controversy update, and that wraps up all of our presentations today. Let me thank our speakers for covering that wide range of topics. We have maybe a couple of minutes left for Q&A, so I'm going to turn to our first question. First question is, are there any actions you've seen clients take in response to the updated guidance around financial transactions? So James, I think that's for you.
Yeah, thank you, Carl. So I think a lot of clients are sort of working with advisors to see whether there are any gaps in their existing policies versus the new guidance. If that's on the very material side for financial transactions, I would say that, this is a more rigorous analysis. But for clients that have maybe less material volumes of financial transactions, maybe they are more inclined to take a more wait and see approach. But I think in general, it's good practice for taxpayers in inbound companies to be familiar with the guidelines, and feel free to reach out to your advisors if you have any questions about potential discrepancies.
All right. Thank you, James. We have very little time left, so I think we're going to wrap it up here. That's all the time we have for today. Thank you again, speakers, for your very informative presentations. This concludes today's webcast. Thank you for joining us. We hope that this session has been useful for you. For those of you who submitted questions that we weren't able to answer in our session, we'll get back to you separately. If you have a moment, please kindly give us your feedback in the following survey. And if you have any other questions or issues that you'd like to discuss with us, please feel free to contact us. Thank you and goodbye.